Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Where are we going with some of these trade policy issues? It's certainly been an issue for investors, financial markets broadly defined, including fixed income markets. Let's talk about that now. Karen Manna, investment director, fixed income, Federated Hermes, Pittsburgh, Pennsylvania. The pride. She's a graduate of Penn State University. I'm a monster fan of Penn State. My son graduated from there at grade school. Karen, thanks so much for joining us here. What do you tell your clients these days when they seem they're getting whipsawed every day by news events as opposed to maybe some fundamentals of the bonds they do own?
Good morning, and thank you for having me. It's a real pleasure to be here in studio with you. So uncertainty is deeply uncomfortable, and treasury markets have been misbehaving, perhaps, swinging in a volatile way, which is not what's desired by fixed income investors at all. So we say, realize that the uncertainty will be resolved when those in the administration resolve it, but position in a way that highlights a couple of things. First and foremost, liquid instruments. Be cognizant of your liquidity so that you can be nimble and position yourself appropriately when we're not doing scenario analysis, but we have actual facts to deal with. Stay up in quality. And for newer money, we like the idea of shorter duration, 1 to 3 years. Pick your flavor there. Multi-sector gives the portfolio manager a little more opportunity to add value to your portfolio. But so basically stay short, stay high quality, stay in liquid instruments.
Well, Karen, I mean, you're the investment director of fixed income at Federated Hermes, and I have to ask you this. How much time are you spending looking at the foreign exchange markets? The broad dollar index is down 3% year to date. I mean, forget about it. I mean, it's non-dollar denominated debt like my emerging market local currency debt, which is leading the way up 5% year to date. Talk to us about the role emerging markets, or for that matter, non-dollar denominated developed market debt plays in a broad fixed income portfolio.
It most definitely has a role, and a role now that is worth consideration. EM markets have withstood the tests of inflation and all the shifts over the past couple of years. And we saw a dramatic tightening in spreads last year that we were able to take advantage of. And then we, in our portfolios, moved back to a more neutral stance. But within EM, what you've highlighted is that you have different ways to invest in the markets: the currency, the sovereign debt, the local currency corporate debt. And that gives the portfolio manager some latitude. So it's an area that we like. But you also highlight the shift to international. And what does that mean for US dollar domestic-based fixed income? That's a different landscape, playing field, whatever you want to call it, than we've had for a very long time.
I'm looking at the INGO function on the Bloomberg terminal, the Bloomberg Index browser. The best performance in fixed income in the U.S. has been U.S. mortgage-backed securities. Talk to us about that market, how you guys view that.
We are overweight to mortgage-backed securities. We see that as a strong positive, and we've been there for a very long while. You have a situation with mortgage-backed securities where you had two of the largest buyers step back, creating a technical opportunity. And that was the Fed, as they've pared back their balance sheet, and then the U.S. banks. So mortgage-backed securities, the second largest market in fixed income behind U.S. Treasuries, a buying opportunity for us, and one that we think will persist for a while longer.
And Karen, does that extend? I mean, residential MBS, we're talking, not CMBS, but let's talk about ABS. Let's talk about some of these other more complicated securitized asset classes. A lot of them are short duration. I mean, what are your thoughts there? I mean, where do you think we should position along the curve? And does that kind of filter through into your willingness to want to invest in, say, asset backs versus mortgages?
In our shorter duration strategies and approaches, we are using asset-backed securities to a great extent. Our asset-backed team that is also in charge of those short duration portfolios has an affinity for those types of instruments and sees value. At the short end, as you point out, they are short duration, not long-term maturity. They offer more value than similarly rated corporate bonds. So an attractive space for the markets, but one that has simply grown. Right? When we came from the depths of the financial crisis and then to their most recent conference in Las Vegas, huge interest in that segment of the market because of the yield that can be created.
Yeah, it's not just student loans, credit card receivables, and auto loan floor plans anymore, I guess, right? In that spectrum. What other sort of non-traditional asset classes, subsectors of that ABS world are you investing in?
We tend to stick to the more defensive elements, what you might call the plain vanilla areas of that market, the more receivables, but we're watching with interest what goes on with that market. We have other areas within alternatives that are short duration and floating that we employ in our portfolios, and that's namely trade finance.
So we like municipal bonds on this show. Actually, it's Municipal Bond Friday. We have a sponsored segment later this morning. Talk just about the municipal segment.
Well, municipals are always near and dear to my heart. It's where I started in the industry as an analyst. Public power and electric utilities were my bread and butter for many, many years. But munis offer nice stability for portfolios. The credit quality is very, very solid. We've seen a walk back in spreads a little bit this year, some dislocation in the market because we've seen a tremendous amount of supply. Year to date, muni supply through early March is up 24%. So you're seeing issuers trying to position, get out in front of a couple of things, right? Move early rather than later. But the credit quality is there. And I think right now, investors are seeking that income protection because it's fairly simple. You're getting more income in your portfolio and you want to protect it to the greatest extent possible.
Well, Paul, Karen makes a great point. A lot of that muni supply year to date has been universities and colleges. So the tax change, the law, the legal changes that are happening, Columbia with the Trump administration is driving a lot of these universities to tap the municipal bond market here. And, my question, and we should be asking Rema Serafi this, is the vice chair of tax at KPMG in a minute, is how much of that, is really, do you want to own in your portfolio? We mentioned ABS, we talk about student loans, we can talk about all of that. Just how much exposure do we want to have to that element, to that end of the market here, Karen?
Well, specifically munis, tax-exempt investing for universities, that's an area where you could see some credit issues, even setting aside tax policy. We all know that there's fewer people going to universities simply because of age wave and challenges and cost. So we have a number of universities that likely, even if you look through the sector to just the underlying financial statements, wouldn't pass credit muster because of how they're positioned. So that's an area where we do have less exposure or would be underweight in our muni or tax-exempt portformalios.
Karen, thank you so much for joining us. Really appreciate you coming in. Particularly on a Friday, get a double gold star.
That's right.
On a Friday. I'm looking around here. You could, it's ridiculous. Karen Manna, Investment Director, Fixed Income, Federated Hermes.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk taxes, because I don't know what's happening with taxes coming out of this administration. And I think a lot of investors are also a little bit uncertain about the tax situation and the strategies of this administration. I think the expectations were for a positive scenario, but we're just not sure. Rema Serafi, she gets paid to think about this stuff. She's the vice chair, head of tax at KPMG. Rema, what are you telling your clients about how the tax structure in the United States is likely to evolve over the next 1, 2, 3 years?
Well, thanks for having me today. It's a pleasure. So it's a really busy and exciting time to be in tax. And KPMG is looking at what we call the tax policy trifecta right now. There are 3 things happening at once. One is the 2025 tax cliff, which is set to expire at the end of this year. The second is global reform. And the third is any other regulations that are changing on the horizon, including the impact of President Trump's tariffs. So our clients are looking at the confluence of all 3 of those things, which are huge disruptors to their business.
So talk to us. What are you hearing from your clients here, Rema? What is the number one issue? Is it the tariffs? Is it potential tax changes from the Trump administration? What are you getting queried on most?
We're getting queried on all of the above. And that's what's super interesting and exciting right now, because they're all happening at once. So because it's multidimensional, we need to model, our clients need to model scenarios for both the short, medium, and long term. And that's what our platform, Digital Gateway, has. It has the ability to take data and put it in one location and be able to model those scenarios at one time and be able to pivot based on, as you know, the daily changes that are happening in the market and with regulatory change. So our clients are basically talking to us about all of those things depending on their facts and circumstances.
So how do you think this tax cut discussion, this negotiation in Congress will go? It's my understanding that they can't do anything until they pass a budget here. So I'm not sure how this is going to play out. What are you advising your clients?
You're absolutely right. No one's sure how this is going to play out, right? The hardest part of passing this bill still lies ahead. We need both chambers of Congress to agree on the provisions of the bill, and that's the hardest part. So it lies ahead. We don't know, and that creates even more uncertainty. And one of the things we're advising our clients, among many things, is to not wait and see. Our clients really need to get after this now and be able to model out the scenarios. Because once legislation starts to become clearer, things are going to move really fast, and companies are going to need to be able to react to a bill. So while it's not certain when it will happen, it probably will. It's just the hardest part lies ahead.
Rema, all my wealthy friends up in New Canaan and Greenwich, Connecticut are worried. They're hedge fund managers, they're private equity managers. They're worried about the carried interest here. I mean, talk to us a little bit about your thoughts there. What are you advising clients on that end?
Yeah, so again, there's so many dimensions to this that have yet to be seen. And like I said, the big picture here is that companies need to, and individuals really need to look at the impact of all the dimensions of the changes. And really time will tell what all the various specific questions are that individuals and companies have related to any impending bills.
Rema, outside of the U.S., what are kind of the key issues that you guys are facing here for your global clients?
So our global clients are facing into that second prong of the tax policy trifecta that I talked about, global reform, which is the impact of Pillar 2, among other things. So BEPS, I'm sure you've heard about it. And so what are the impacts outside the U.S., even though the Trump administration has indicated that it's not going to be amenable to BEPS Pillar 2? Companies that operate outside the U.S. still need to comply with Pillar 2 regulations that are in place in the countries in which they operate. So we're advising our clients on their global footprint and looking at what tax planning or what operational changes they need to make in light of that uncertainty as well.
Rema, I know KPMG is the first of the big four to be licensed to practice law here in the U.S. What's the motivation behind that?
Yeah, so KPMG is really proud to be the first of the big four, KPMG Law US, to provide what is really an increasing need in the legal market space today, which is providing process-driven, technology-enabled services for our clients. And that is a real growing need. The volume of transactions, the volume of contracts that need to be managed, the ability to put that on one technology platform, which I talked about, our digital gateway platform, is really important in the marketplace and being validated by our clients. So that's what we are going to do. And we're already getting tremendous receptivity in the market for that need.
Rema, thank you so much for joining us. Rema Serafi, Vice Chair for the tax practice at KPMG, the big four. I remember when they're the big 8.
Oh my God, yeah.
And then the big 6, and now we're down to the big 4.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Let's talk about the global supply chains in a world of rising tariffs. What does it mean for trade here in this part of the world and around the world? Alyssa Rusanoff joins us. She's the CEO of L Tech. She joins us here in our Bloomberg Interactive Broker Studio, which gets her double stars because it's a Friday being in our studio. Alyssa, thank you so much for joining us. What are you telling your clients about tariffs and what the ultimate impact will be on trade between the U.S., Canada, U.S. and Mexico, the North American in general? What are you telling your clients these days?
Yeah, so pleasure to be here. There is a lot of volatility, obviously, in the markets, but I'm finance and trade. So there's a lot of cross-border trade that I'm seeing on my side, whether it's Mexico, Canada, or other parts of the world. And obviously, there is a lot of uncertainty happening and a lot of suppliers, small suppliers in Mexico, in Canada, bigger corporations, and specific sectors that are really impacted by it. So I finance a lot of industry related to cars, car parts, energy, commodities like coffee, which I'm a big consumer of, obviously,
Right.
being in New York, a true New Yorker. So there's certainly a lot of volatility in that sense, meaning if you're looking, for example, at the car parts or just car export/import trade, that's a crazy amount of operational volume, because it's not just a car is being, let's say, manufactured in Mexico, just goes into the US and you can just put a tariff on it. The reality is the car parts go back and forth, maybe 3, 4, 5,
Really?
6 times. That's absolutely right. There's a lot of operational logistics there, because apparently shipping is actually quite cheaper than manufacturing in certain regions. So reciprocal tariffs do not necessarily make sense even from an operational standpoint. It's just really, really hard to do. And unfortunately, trade is not necessarily digitized. So operationally, you have to have tremendous amount of staff on the U.S. border or Mexican border, Canadian border, to really be able to do all that. And then if we're looking at the car sector, if, for example, we will impose 15 to 20% tariff on Canada and Mexico, our car price will probably go up by 4 to 8K. Right, so that's a lot that goes on the U.S. consumer, obviously. So, and that impacts a lot of other jobs, not just the consumer, that obviously is an inflationary matrix, but it also affects a lot of jobs, because we have a few largest ports in the world, whether it's New York, New Jersey, California, Pennsylvania, etc.
Alyssa, I love, and Paul, I love trade finance as a strategy. It's been around for so long. It's been a cash cow. I mean, historically speaking, and please, Alyssa, correct me if I'm wrong, high single digit, low double digit, very smooth, returns over time. Can we, as an investor, still expect those same types of returns? I mean, I love asset classes that are complex and structured where you can engineer performance. Is that still the case in trade finance?
That's absolutely right. Not just you, but my investors like that a lot. So I've been financing for over a decade now. It's very true. It's a very liquid market. There's a lot of volume. There's a lot of various types of supply chains and gaps where financing is needed, whether it's on the supplier side or on the customer side, which is called receivable financing or factoring. So there are different structures you can create to actually finance a trade. And there's a lot of cross-border trading, obviously, because we still live in the globalized economy, globalized world. So everything that we're seeing in front of us right now probably is coming from other countries in certain supply chain factors of it. But in terms of volume of it, if the tariffs do occur and they are imposed, so I would expect the volume to go down. And we've had it last year, right? Sometimes we just have to go back in history, and we can look at Smoot-Hawley Act or law in 1930, and the global trade back then went down by 60+%, right? So it impacts the U.S. economy, it impacts the global economy. And I guess investors are very still interested in the trade finance, but we're just concerned about the volume of it.
And just 30 seconds left. April 2nd, is that a big date for you?
Yes, I'm having a lot of coffee. That's coming from Brazil or Colombia.
Okay, right, and so subject to tariffs. Alyssa Rusinoff, thank you so much for joining us. Alyssa is the CEO of LTech, talking about trade finance in a world where trade is coming under some pressure with all the new potential policies coming out of this White House.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lots of news flow coming out of Washington, D.C. Let's get right to it. Jennifer Lawless, politics professor at the University of Virginia, who I will note are not in the men's tournament, but it's just brutal. Jennifer, thanks so much for joining us here. There's lots of ways to go here. Let's just talk with a topic we were just asking Margaret Brennan and CBS about. Reports that Elon Musk is getting briefed about China at the Pentagon today. What do you make of this story? What are the risks? What are the opportunities? What do you make of it?
Well, good morning. The entire thing is quite stunning. It's unheard of for somebody who's not part of the administration or not a member of Congress to receive this kind of briefing, despite the fact that he has received, several types of clearance. The speed with which this briefing is taking place, given that this information was only recently shared with other members of the administration, is also somewhat stunning. And it just demonstrates the access and proximity that Elon Musk has to Donald Trump and the fact that he has a finger in everything, not only domestic policy and the economy and DOGE, but also in national security concerns.
All right. We have to note certainly that President Trump has denied these reports. So we'll see how this news story plays out throughout the day. Another big thing coming out of the Washington, D.C. is an executive order to end the Department of Education. Wow, yeah. I wasn't sure that was a thing, but apparently it is. How is this going to play out?
Well, the executive order begins dismantling the Department of Education. You actually need an act of Congress to get rid of an agency, but there are already members of the House and the Senate who have introduced legislation to do just that. So what Donald Trump did with the executive order was make it clear that he was serious about dismantling the department, and he signaled to members of Congress that they should move forward, and they are. And this, too, is quite stunning for a variety of reasons. We knew that he planned to move student loans outside of the Department of Education, but the department does far more than administer student loans. When we think about education funding, standards and testing, school lunches, and those kinds of programs, access for students who have learning disabilities, all of that is now ostensibly going to get returned to the states. And that means wide variation across the board, no real federal standards. And the extent to which you receive a decent public school education is now going to be contingent more than ever on where you happen to live.
And we see a lot of universities here in the U.S. turning to the public markets to raise money as, I guess, a war chest in against all this. Talk to us a little bit more. I mean, what is the economic impact of all this nonsense with the Department of Education?
It's pretty substantial. I mean, partially it will have to do with public schools, K through 12, which is what I was just talking about. But universities and colleges across the country are also playing a major role. If their funding is linked to this administration or what Donald Trump's priorities and preferences are, they're in a very precarious position. We've seen, for example, the more than $400 million cut to Columbia University a couple of days ago. Penn received notification that it was going to be losing $175 million because of its transgender athlete policy. So universities and colleges across the nation now have an incentive to do two things. First, raise alternative sources of funds so that they can continue to exist if they're targeted, but also, to the extent possible, comply with what Donald Trump is asking for because they rely so heavily on federal funds.
We know that student loans were postponed under the Biden administration during the period of COVID. Talk to us about that front. Do we expect, students or former students to begin paying back their loans anytime soon? And is there any news on that?
The tricky part about that is that the administration has said that they obviously want people to pay them back immediately, that they don't support the delays that the Biden administration implemented. The problem, though, is that they've gutted the people who are the ones monitoring this and the people who can actually share with students the amount that they owe and how they should go about paying this back. And so they seem to be at cross purposes with themselves. We'll see what happens. But the latest reports that I've seen suggest that neither the Department of the Treasury nor Commerce want to absorb responsibility for student loans.
Jennifer, I'd love to talk to you about the politics of the Democratic Party here. You think about the White House, you think about both houses of Congress, the Republicans obviously won all three, but by very, very narrow margins. Yet the Democratic Party has been essentially invisible since President Trump was inaugurated. He takes all the air out of the room. Are you surprised that Democrats haven't stood up to this president more forcefully?
I am. I would say that Democratic attorneys general across the country have been doing an insanely, high level amount of work to push back through the courts. So I think that the Democratic attorneys general across the country have really risen to the occasion. When it comes to elected members in Washington, it's somewhat puzzling. And we saw last week, based on what Chuck Schumer did, that the party is not entirely on the same page either. I think some Democrats thought that the wind would eventually come out of the Trump sails, and they assumed that it would be sooner rather than later. So they just kind of wanted to sit around and wait for that to happen. It hasn't happened. Others think that they should just compromise because Trump is going to get what he wants anyway. And so maybe the Democrats can extract something. And still others think that because there's unified control in Washington, the Democrats have a responsibility to put up a unified front and try to block everything and then blame Republicans for any unpopular outcome. And unfortunately for the Democratic Party, they're not all on the same page and they're all just kind of flailing.
All right, very good. Jennifer Lawless, thank you so much. We appreciate that. Jennifer Lawless, politics professor at the University of Virginia. Lovely Charlottesville, Virginia.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Kathy Hepworth, she is a portfolio manager for PGIM Fixed Income, not just PGIM Fixed Income, but the head of the PGIM's Fixed Income's Emerging Markets Debt Team. I just don't know how this happened. Kathy, thank you so much for joining us here in our studio. Really appreciate it. Emerging markets, with geopolitical tensions, with global tariff issues, how is your market kind of performing these days?
Well, the interesting thing is, so far this year, from a total return perspective, when we look at credit, we look at FX, and we look at local rates, it has very positive total return numbers and outperforming other investment grade and even U.S. high yield market segments. And there are reasons for that. Some of that is the attractiveness of the carry in what's deemed to be a still okay world. Big question mark there, though.
Yeah, no, I mean, Kathy's doing not doing our asset class justice. I just have to say it is the best performing asset class year to date, and there is a good reason for that. The reason, in my mind, is the FX. Right? I mean, This is an FX story. This is the euro versus the dollar, and spillover effects not just into the broader EM, but more specifically the Eastern European segment of the market. Talk to us a little bit about Poland, Hungary, Czech, the CE4, Romania. I mean, are investors really finally in fixed income putting their money to work there locally?
Well, a couple of things there. There have been decent portfolio flows and FDI flows into some of those countries, Hungary in particular, even Romania. But I think what we saw out of the EU over the past couple of weeks really is a sea change. And I think that can help anchor some of those countries in the region. Of course, in the context of a trade war, some of those economies are quite open economies and they are vulnerable. So you have to balance those different risks, those trade-offs, if you will, as to how those countries might be impacted by a trade war versus are they going to get flows otherwise?
Right. Well, I mean, the periphery there, I mean, the EU represents, Paul, 75% of all exports out of Czech, Hungary, Poland, that's sort of Eastern European periphery. So, you can see how it's kind of tracking there. But, the one market which really caught my eye this week, it's the only country in the planet that's actually hiking rates in the face of what we're seeing here, and that's Brazil. They just hiked rates by another, 100 basis points? I mean, where's the policy rate? 14.25, Kathy? Yeah. I mean, talk to us about Latin America, about carrying in some of these sort of high-yielding emerging markets.
And that's exactly what's driving those high returns is its carry. So Brazil is doing the right thing, right? In the face of uncertainty and credibility, as it pertains to fiscal policy, actually even more so than inflation in Brazil, they're hiking rates, to try to anchor expectations there. And that's why it's so attractive, I think, to be investing in the currency, as well as some of the local bonds as well. When you think about the vulnerability of Brazil to a global trade war, it's really low when you compare it to, say, a Mexico, right, which clearly has much more direct trade links with the U.S. I'm not saying, it's going to all end badly for Mexico, because I think Mexico has some leverage, but Brazil is somewhat differentiated in that regard. So I think those investors in the currency are also looking at from that perspective as well, from the fundamental perspective.
Well, Kathy, I know you've been busy this week, focused on Turkey probably. Talk to us a little bit about what's going on the ground in Turkey.
It's all about confidence and credibility and the market getting ahead of the fact that, oh my God, are we going to get back to that period before the recent change in policy where maybe you're going to see dollarization again in the local Turkish economy? And that's what all those levered investors, I think it's probably close to 20 billion that we've seen outflow from the currency markets and the local bond markets so far this week. We won't know the numbers until next week. Is that going to put pressure on the locals who perhaps are going to be less comfortable owning the Turkish lira? I think the fact that the Turkish Central Bank, hiked the overnight rate this week was a very good thing, a good measure.
Kathy Hepworth, portfolio manager, PGIM Fixed Income. Kathy, you mentioned Mexico, that you don't think it's going to end terribly for them.
Right.
Boy, I could see a scenario where it could end terribly for them. How do you guys think about Mexico?
Mexico has leverage in that the economy between Mexico and the U.S. is so integrated, right? Particularly in the auto sector and some of the electronic sectors, that it's really not in the U.S.'s best interest to impose maximum tariffs on Mexico. So I think in that regard, Mexico has leverage because it's kind of a negative impact on the U.S. economy. And I don't think that that's what the U.S. policymakers actually want to happen. And there is credibility with their institutions. The central bank there, we think, is going to continue to cut rates. And that will help put a floor on growth. But of course, in a really worst case scenario, USMCA is sort of disregarded, then of course Mexico can enter recession.
Kathy, all eyes are always on the U.S., even in emerging markets. And, I just want to ask you, when you're, in the war room with Greg Peters and Tom Percelli and the U.S. guys over at PGIM, what are they thinking right now? I mean, I think the market, OAS, U.S. front ends are pricing in 2.5 cuts through year end. I think it's backloaded, but still, I mean, it's quite a lot compared to where we just were. I'm wondering, where do you think rates go from here?
Yeah, so caution, right? And tail risks have definitely gotten fatter. So, and we do think the risk of recession has risen. It's not a base case. It makes perfect sense to have 2 or 3 cuts priced in. Is that a Fed put? It's not clear to me that's a Fed put. I still think you need to be cautious in the overall amount of risk that you're taking. But as an active manager, clearly that presents opportunities, underweights and overweights. And, EM is the great asset class to do that, right? Because there are countries who are less vulnerable than other countries, and countries who would be hurt less than those most vulnerable.
Kathy, I can't let you leave without asking you about China. I mean, look at the MSCI. I know we're not equity people here. I know that, Kathy. You don't have to remind me, but the MSCI, China's up like 30%. I think Bob is up something like 70%. Is that just, is that just a trade, or is there any longevity to that? Is there anything structural, fundamental that an investor can get behind there?
I do think there's something fundamental happening in China, and I think that we heard it a few weeks ago. And I think they are now ready to focus on the consumer, to deal properly with the problems in the property sector. And they've been very well behaved, I think, vis-a-vis the Trump administration so far. And there's more yet to come, right? We haven't seen the full extent of what's going to happen with China. But I think that China is much better prepared this time than they were in Trump 1.0.
Last question from me. There are only a very small handful of currencies that are actually down relative to the dollar this year. India and Indonesia are 2 of them, the rupee and the rupee. Talk to us a little bit about Southeast Asia. I mean, how should investors approach that region? Yeah,
so clearly from a currency perspective, I think they're a little bit less attractive. From a local rate perspective, it's more attractive because of deflation. I do think they're going to be cutting rates. Indonesia is a bit of a change, right? Because the market is concerned about the Minister of Finance potentially leaving and the new president having some policy changes. I think in India it was in part because what happened in the fourth quarter and they used reserves to. So I'm much more constructive on India than I am on Indonesia.
That was a masterclass, folks, in emerging markets. Damian Sassower and Kathy Hepworth, Portfolio Manager, PGIM Fixed Income.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.